So I have a presentation here. I wanted to talk about what's happening in U.S. electric markets in the Northeast, where we have the independent system operators, and there's a fair amount of trade back and forth with Canada. I do, as Nick said, a fair amount of work at FERC in Washington and with some of the Northeast grid operators. But we'll go to the next slide. We did a report for the Wind Solar Alliance on looking longer term about what the power market is going to look like, assuming there will be a lot of wind and solar, which of course we think is a safe assumption. One thing we did was sort of start from scratch and think about what a power system should look like, not just how do we get from here to there, but what should it look like if you had a blank slate. And we came up with these principles, the 4 F's we use to remember it: flexible, fair, far, and free. The main thing is really the flexibility. Obviously, with non-dispatchable variable resources, you need other resources that can be dispatched, and in some cases, the wind and solar to be dispatchable themselves. The power system needs what it needs at different times, and that varies over time, and the wind and solar output varies over time. So you need a very fast and flexible system. A couple of details on that: the closer to real time the systems can operate, the better. That makes them more flexible. So things like 5-minute dispatch doing things 2 or 4 hours ahead rather than day ahead are much better for wind and solar. You pretty much know what the wind and solar output will be the closer it is to real time. Although forecasting is improving in all time frames, you obviously know more as you get closer to real time. And using small building blocks is another important design principle that we identified, partly because we have dispatchable, flexible resources like demand side and storage that are sometimes of short duration or just smaller, but you can add them up and get large impact. And so the system operators need to get out of the mold a little bit of only thinking about very large units and how they get ramped up and down, but be able to accommodate all of the smaller units. Fair is the principle around technology neutral. A lot of these resources can provide extremely high quality, essential reliability services, so frequency and voltage support. In fact, the inverter-based resources, wind, solar, and modern batteries can provide much more rapid and accurate response in the sub-second to seconds time frame. So products like fast frequency response, which they're now instituting in Texas, will be a valuable product. The systems could use that service, and these resources can provide it. But they can only do so if the tariffs and the rules become truly technology neutral. FAR is the principle of large geographic areas. So this is both trading across borders, state borders, provincial, national borders, RTO borders, as well as just operating larger regions. In the U.S., in some areas, we have balkanized smaller systems where it's very expensive to do the power system balancing in a small area, but it's much cheaper if you do it over a large, wider area. And then the last one is free. Bilateral contracting is something that renewable developers like every generator does to get long-term PPAs, long-term contracts, and it's good for consumers. Sometimes the system operators aren't very accommodating of long-term contracts, and even though it's important to have 5-minute markets, sometimes there's an emphasis on requiring focus on just that. So you should have both. You should have the long and the short term operating together. So those are the principles that we're recommending that all regions work on. These are pretty generic. We were focusing mostly on the PJM Mid-Atlantic U.S. region and MISO in the Midwest, but these are pretty standard. One thing about the evolving load shape that's important is in terms of how systems are going to operate, particularly with a lot of solar. If you look at this is a graph from First Solar, which did a study with Tampa Electric. You can look it up if you want, Tampa Electric Corporation. The original line there with the blue and the orange has a standard load shape. In the afternoon, there's the peaks, and it's kind of a gradual ramp up, almost a sine curve through the day. But when you add a lot of solar, you're left with what the dispatcher has to worry about is just the blue. So it's a thinner peak, and it's at the end of the day because solar serves the middle of the afternoon, and then you have the early evening to worry about if you're a system operator. This is the same thing that California is worried about. You might have heard about the duck curve. But that blue line, if you follow that line, you'll notice it's pretty steep at the end of the day. So you get to 4 or 5 p.m. or when the sun goes down, the system operator has to ramp something up awfully quickly. But it also doesn't have to have it last as long. So this creates, I think, demand for fast response units. Batteries can do this pretty well. If you notice, that peak is pretty thin, so a 3-hour battery could serve most of that peak. They could charge in the afternoon when there's a flood of solar, and they could discharge at the end of the afternoon. So that's one example of how the changing load shape is going to affect the value and the demand for different resources. I'm going to talk more about how there are different time frames for storage, and there's seasonal balancing needs that doesn't show, but that's going to be another source of value that other resources are going to have to offer. In terms of hot topics in the U.S. and the Northeast RTOs, these are the main issues that are the source of contention, debate, activity, committee processes, FERC proceedings, and everything else. The first general category is state policy and its interaction with wholesale market rules, and I'll get into that in more detail, but there's this thing called the minimum offer price rule, or MOPR, and it takes place in the capacity markets. So all 3 of the Northeast U.S. capacity markets are going through some variant of this same issue, where you have state clean energy policies and you have federally regulated markets. So FERC regulates the ISOs, and that interaction has been very challenging. The second general topic is fuel security. You might have heard about the Trump administration's desire to bail out coal plants. That initiative led to discussions of fuel security, where the ISOs and the RTOs say, well, we don't really need baseload per se, and we don't necessarily need old coal plants with large stocks of on-site fuel. What we do, however, need is fuel security. So ISO New England and PJM in particular have been working on this, and just having that discussion has sort of hopefully staved off the coal bailout initiative, but there are still a lot of questions about how the different resources play in the markets when they think about fuel security. So to just get one more level of detail into each of those topics, and I'll turn it over to Jason and look forward to the discussion. But in the a couple slides on fuel security first. This is ISO New England's study, the operational fuel security study. It's on their website. I don't expect you to be able to read all of what's on here. Just the point is they did a bunch of scenarios. Each of the scenarios are lined up on the bottom. And then they rank them from more reliable on the left to less reliable on the right. The bar reflects how many times they have a violation of their reserve requirements. So, some scenarios toward the right basically left them without power at certain times of year, so they had these violations. And they use this. New England is obviously concerned about gas import capacity and winter cold snaps when gas has competing uses, namely space heating. And so in certain scenarios, if they run out of that, and they're particularly focused on these extended cold snap periods, like a 10-day period where they might run out of the gas they have, they might run out of the backup fuel that they have, and they might run out of deliveries of that fuel. So then what do? That's what's keeping the system operators up at night. So they went through these scenarios, but interestingly, if you look at this this study, the high renewable scenarios were actually quite good. They were all lined up along the left side, and that reflects system diversity and also the fact that, even in the middle of January, the sun does come up every day, whether it's cloudy or not, you're getting some output, and the wind tends to blow pretty well during these cold fronts that come through. And it's not really a capacity need. In the electric industry jargon, there's the capacity and the energy. This is really a 10-day, how many megawatt hours can we get from everything over that period, which is really more of an energy need. So wind and solar actually do provide a fair amount of megawatt hours over that period. So the renewables did well, but this also reflects imports. So imports from Canada included, and hydro among that, were in the higher reliability scenario. Just to talk about PJM for a minute, the point is generally the same. They put it a little bit differently, but they went through scenarios of what they think that they need. They wanted certain reliability objectives met, including frequency response, reactive capability, ramping capability, fuel assurance, and flexibility. And then they looked at 3 general scenarios of fast retirement of coal plants replaced by gas, slower retirement of coal plants, and then a higher renewable portfolio. The renewables did pretty well on flexibility and the other objectives, but in all cases, the fuel assurance is the one that came out short according to PJM. So that's where, again, they're considering this same exact issue, and as they've proceeded in their analyses, they've also crystallized on this sort of scenario of kind of the 10-day cold snap type of situation. What do they do when they run out of fuel and they get what they get from the wind and solar and the hydro and the gas that they have? What do they do then? Now PJM has much more of a gas supply, so they don't have the gas import constraints. So that's really where the debate is right now. Do they really have a problem since they're sitting on all that Marcellus shale gas or not? But there's also a debate about how much renewables provide in this. And then both regions are starting to move into the market design question. Well, if they have this need for this fuel assurance in this winter cold snap period, is that sufficiently addressed by the current market design, or is that a new product? Do they address it with changes in their capacity market or in their energy markets? How do they value it? What's it priced? All of that is going on. So, of course, it's a rich area for all resources to engage in. One thing that comes up in a lot of this that's also coming up in the studies of scenarios like 50 or 80% renewables is that the longer term balancing is an important need of these systems, whether you call that a product or whether it's an energy product that is just at different times. It's this longer term balancing resource that's much needed. Batteries are going to have a huge role, but those are good in the 3 or 4 hour time frame. What do you do in the multiple days, weeks time frame? And so hydro and other resources are good for that. And again, assuming we're going to have a lot of wind and solar providing a lot of very low cost energy, there's this increasing need for the longer term balancing services. So then to I guess just 2 quick slides on the state policy issue. Again, the 2 hot topics in the Northeast are the fuel security we just talked about and state policy. Some of you can read this quickly, others aren't as facile with economics, but basically what's happening is the yellow bars are the minimum offer price rule that I mentioned before, where the ISOs and RTOs and FERC have said, well, if some resources are getting the benefit of state policy, which is renewable energy credits or zero emission credits for nuclear, then those resources have an advantage in the market, and that's unfair to the rest of the participants. So what we need to do is correct that by raising the capacity bids of those subsidized resources. So the resources that have the yellow bar, when they go into the auction, they get their bids increased administratively. And of course, those suppliers don't like that. The renewable wind and solar generators or the nuclear generators, they don't like that because they might get priced out of the market. They might not be able to sell their capacity. The other incumbent generators, the unsubsidized generators, the gas, nuclear, coal that are on the system, they love it, and they're actively lobbying for this rule and for expansion of this rule. So that's sort of the fight. Consumers, of course, dislike this. This raises the cost. You see the original price there on the left, and it goes up higher with the MOPR. So this is a huge issue. I mean, it's a cost impact of $1 billion or more in each of the three ISOs and RTOs for consumers, so it's a very contentious debate at FERC. It appears with our current new commissioners, we've got 2 Republicans and 2 Democrats, and they seem pretty much split 2-2 on it, which also creates this extra unfortunate drama in PJM, the last slide here, which is that to deal with this MOPR issue and state policy, PJM proposed some fundamental changes in its capacity markets, addressing those top 3 issues there of which policies should be mitigated, what should the bid level be, and should there be an opt-out? So if you sell a bilateral contract to somebody and avoid the central auction, do you get out of this minimum offer price rule? PJM sent those 2 alternative proposals into FERC, and then FERC last June declared the entire market to be unjust and unreasonable. So it didn't accept either of the 2 options, but it just said, you know what, this is so messed up, the entire thing is unjust and unreasonable. So here we have the biggest market in the US, the PJM market, and the capacity market that is the main sort of source of revenue. Energy is as well, but capacity market is a huge revenue source and huge cost for consumers, and the regulator declared the whole thing unjust and unreasonable. Now we have a 2-2 split among the commissioners at FERC about what to do about it. And so, I don't know if you heard about the Pottery Barn rule, but if you go into the store and you break it, if you break it, you own it. Now FERC owns this thing, and it can't figure out what to do about it. So it would be funny if it weren't tragic for a lot of market participants. And it's really not clear how they're going to get out of it. They promised an order January 4th of this year or sooner, and we're more than a month late. And so as far as anybody can tell, we're just hung up with no way out of this. So all of those questions have big question marks next to them. There's still the question of whether there should be a seasonal capacity market. Certain resources, wind, solar, hydro, air conditioning based demand response are seasonal, i.e. much stronger in one season than another. So arguably you have different supply and demand and should have a different market for each season, but we don't. And then since all of this stakeholder debate is taking place in the capacity markets, and it's really the energy markets that signal what resources are needed at what time and place, I think PJM management is shifting more towards maybe we should move more back to where the energy markets are the focus rather than the capacity markets for revenue and consumer costs, and maybe we'd get better price signals and consensus on how to move forward that way. I'll leave it there. Thank you.
Thank you, Rob. Jason, and take notes of any questions you may have, and I guess our two panelists will be able to field them as they come.
Okay, so I'll be really brief, and what I want to do is kind of back things up a bit and talk more about trends that we all know and back that up with some numbers to give rise and rationale and conclusion of why I agree with Rob. And I agree that the organized wholesale markets need a lot of changes. I believe whether it be federal government policy, provincial government policy, or state government policies regarding supply mix, climate change, things like that are not going away. And I do think we have to rethink what we're doing in Canada to the jurisdictions with wholesale markets. And I also want to end off by what I think are some implications for Quebec and Quebec suppliers and customers. So we all know this general trend. It's international with respect to more renewables coming on the system. And by renewables, it's not just wind and solar, but also hydro. I have a slide later on showing where the costs are generally going in North America regarding this. So this is a trend that's going to continue. The question is, how do you integrate these resources in organized markets and even in utility markets where there isn't a wholesale spot market? I think what's really interesting is looking at the US as an example. And when I look at this chart, there's clear cycles for me, trends and patterns. So when you look at the 1950s all the way to the mid-1980s or so, when you look at the navy blue color, it represents coal-fired generation development. So the integration of coal, and that makes sense. But then what you see overlapping with that, starting in the 70s, going through the 80s, the red is nuclear. So we had a little bit of a nuclear generation renaissance in terms of deploying those big units. And then after that, starting in the 1990s, heading into the 2000s, in orange is the natural gas fired generation build out, a lot of that being combined cycle. And I would also suggest the reason why there's such a peak, the magnitude, the amount of natural gas fired generation that was built in the early 2000s was the opening up of organized wholesale markets. So we would recall back in the late 1990s, early 2000s, there was a lot of merchant investment across the US and Ontario and Alberta. And I think a lot of that was on the backs of companies like Enron and whatnot. And then that kind of got scaled back given the crisis in California with blackouts and some of the issues or big issues that Enron ran into. And I think it's funny that you fast forward today, you don't see a lot of those companies anymore. And I'll talk more about who's owning these assets in a second. And if you get to the far right-hand side of the chart, the green and yellow is really now the wind and solar. So that's coming in, and I think that's the next trend. And when you break it down further, using some US data again, for the first time in 2016, solar was the largest developed supply-side resource. So it beat out wind and it beat out natural gas. So it's the on the pie chart on the right-hand side, the orange and red, you add that up, that's the solar deployment in the US. And if you go back to the left-hand graphic, on the bottom, below zero, the coal is gray, and you can see a sliver of orange being oil. So a lot of the oil-fired generation, but most of the coal-fired generation, as we know, is being retired. And it's not just being retired based on government policies and regulations. It's also being retired because of just simple age and cost. So we're seeing that happen all over North America, especially in the jurisdictions that have less hydroelectric generation. A lot of the supply assets are now aging. They're very old.
40, 50, 30 years old, and they're starting to retire. I think this is the beginning of where the story is going to get very interesting, especially in jurisdictions with good solar resources where the sun's shining relatively a lot. Same with wind resources where the wind's blowing relatively a lot. So I kind of take my cues a lot in terms of where the money's going and where the investors are. So this is going back about a year and a half ago. NextEra, a subsidiary of Florida Power and Light. NextEra Energy is the U.S.'s largest renewable energy generator. And they also own other assets. They do own nuclear, they do own gas, but they're largely a wind and solar generator. So on their investor call back in the summer of 2017, when you take out the tax credits from the US and you look at the solid blue bars to the left, that's without storage. You can see the price on a levelized basis right there and being cheaper than some of the conventional resources, being nuclear, coal, and gas. And I think what's really interesting is when you pair solar or wind with storage. So to firm up the ability to produce energy when the system most needs it, if you combine that with storage, that's the storage adder, that's the shaded blue on top of the solid blue. You still see that those types of hybrid solar plus storage, wind plus storage resources are now being, on a cost basis, the same or on par with the conventional resources of gas, coal, and nuclear. And I think storage has the potential to be the game changer that way, because for a while we've been hearing, well, we can't rely on the wind because the wind isn't always blowing, and by the way, it's blowing at night, and that's not when the system needs it. We can't rely on the solar because it's only available during so many hours a day. But with the ability to take that energy and store it, and then as a complete resource being dispatchable to meet some of the issues that Rob was mentioning, with the need for quick start resources and the ramp during certain parts of the day that's only so many hours, that's really interesting. And by the way, it has the ability of making money in other types of markets for renewable energy credits or RECs or environmental attributes or those sorts of things, where it will beat gas and coal that way. So we're starting to see some of this really happen. So this is one of the utilities in the US. Xcel Energy is one of the biggest utilities. And this is a result from a procurement that they had basically in the western part of the US out of Colorado. So end of 2017, they announced results from their request for proposal. So you can see just the second column from the left, the number of bids. Then you can see the megawatts beside it. So there are a lot of projects bid in. But I think what's really interesting is when you look at the middle of the table, the wind all the way down to the solar plus battery, and then you walk over to the cost, you're talking between $18 to $36 a megawatt hour, or 1.8 cents to 3.6 cents a kilowatt hour. Those are outstanding prices. So if you're now getting a resource that is clean and it's very flexible and dispatchable, it's starting to be a game changer. And if I fast forward now a year later into Hawaii, these announced results in October show that. And I think it's really interesting to see a Canadian firm being successful with Interjex out there in Hawaii. And those prices range from 8 cents a kilowatt hour, or $8 a megawatt hour, to 12 cents. So these are all solar plus storage, you know, and some of you might be saying, well, okay, in Colorado the wind blows a whole lot, in Hawaii the sun shines all the time, so yes, you would expect to see prices potentially get that low. But there is a general trend. So I've got one more slide about that, but just identifying the storage side of things. This is a recent study by Bloomberg New Energy Finance, and clearly showing the cost of lithium-ion battery massively decreasing from its 2010 levels on the left-hand side all the way down to 2018. That's a pretty steep curve in terms of where the cost of lithium-ion battery storage has gone and will continue to go. So the Ontario ISO is going through a process to redefine its wholesale market. And Ontario wants to bring in basically all of the different types of markets that many of the US markets have. Day-ahead market, locational marginal pricing for energy. But there's been a recognition in Ontario that we have a lot of different types of resources on the system. And in a couple years, Ontario will basically be on a capacity or megawatt basis, 1/4 nuclear, 1/4 hydro, 1/4 gas, 1/4 wind and solar. So there's been a lot of dialogue in Ontario. Are we redesigning the market properly, considering where the trends are going, especially with more wind and solar? And you can see from this graphic, and this was used in some of the IESO analysis last year, the light blue line, the one that's below all the other lines, is basically the cost curve for solar. And then on top of that's battery, then on top of that's wind. So when you see where the trend's going into 2020 or 2030, it's clear. So that's something I think we all need to think about. And again, that gives rise and gives reason for the types of things Rob had said in terms of some of the dialogue and debates in the US between states and the policies that they want to implement, what customers want, but how do you organize a market and how do you make sure that the market's working properly to maintain reliability as well as being cost effective for customers. So there are basic challenges all over the place, and those are a lot of words there, and I'm not going to read them, don't expect you to read them. I think to summarize, governments aren't going to stop what they're doing. And they're not going to stop what they're doing because they know about this trend. And they understand what customers want. They want cleaner resources and they want cost-effective resources. So they're going to keep going. So how do the markets react to that? Because obviously there's a lot of incumbent generators and resources that have been around for years that still need to operate and they still need revenues to operate and they're still cost effective. So we have to think about that. We have to think about two things in addition, where policies are going with respect to climate change, and I've talked about that, but also what's happening on the customer side in the sense of customers are becoming much more active in terms of managing their energy needs. So a new buzzword term that's being used a lot, distributed energy resources, or DERs. So we're talking rooftop solar connected to distribution systems, energy storage connected to distribution systems as examples of DERs. There's more and more of that happening, and the wholesale markets were organized to really balance flow on the transmission system and set prices for bigger resources on the transmission system. But if you're getting more and more supply from the distribution system, how do you integrate that into the market? Does the utility at the distribution level become more active that way? Or does the system operator at the transmission level reach down and become more active on the distribution side? So these are things that we're all struggling with today. Every market is different, and using the US first and just kind of repeating a little bit of what Rob said, New England is going through a lot of changes. This week, they're running their forward capacity auction based on a whole new design to try to better integrate some of the contracted renewables in a pretty complicated way. So I think we're all curious to see how that's going to go. PJM, as Rob had said, they've recommended things that the federal regulator didn't like. Well, they're still going to, try to make changes to their wholesale market. I think New York is interesting. They're basically saying there's a proposal on the table to directly price carbon in their wholesale energy market. So basically, there'd be a carbon adder under certain circumstances, pending on which resource is dispatched in New York, and then sets the price. So in other words, trying to value carbon in the energy market to reward cleaner resources and penalize more emitting resources. Rob had briefly mentioned Texas, and my take-home point with Texas is they're realizing, and they've always realized, that the energy market's really important. So they tend to let prices clear at very high levels to make sure that all resources that are economic are getting sufficient cost recovery in that market. And California and a lot of the western part of the US is worrying about, we've got a lot of wind, we've got a lot of solar, how do we integrate that? And there's been a lot of work to think about how to do that in the real-time energy market, and Rob alluded to that a bit. And I purposely left Canada alone, and in our two wholesale markets, being Alberta and Ontario, it's kind of interesting to me because they're reaching south and looking to bring in market features that have been in play in the US for 15 to 20 years. And I think the both of us have kind of been saying that those markets are being challenged based on the changing resource mix and more renewables coming in, and I'm also saying more distributed resources coming in. So there's a lot of questions in those markets whether they're going in the right direction. And I mentioned in Ontario, there's some concern about that. That's why there's been analysis. I think Alberta is a little bit of an outlier in all of this. Like some of the US jurisdictions, Alberta is sitting on a lot of supply of natural gas. So there's probably some runway for them to still have this type of market because they're going to be basically a gas-fired generation dominated market. So here's my final slide in terms of what does this all mean. So when I think about Quebec, and I've had reason to do work in Quebec quite a bit over the last several years, so understanding this market a little bit, I think one thing is Quebecers enjoy low electricity rates. And that's partially because of the patrimonial supply, but you've got natural hydro resources, and we all know that. So I think there's always going to be some form of ceiling to how much distributed solar and distributed storage and even grid-connected solar and storage that would actually occur in Quebec. So there's a little bit of a cost equation that comes into play because Quebec is just naturally blessed with relatively lower cost energy based on the hydro resources. But I do think that obviously there have been tons of opportunities to export into the US. But I do think the exports into the Northeast are going to be challenged because of some of the cost effectiveness that we're now seeing in some other markets. So we were talking briefly before this session about Hydro-Quebec and their project in the transmission line through Maine. It's interesting because obviously that's been challenged. It was challenged when it was going through New Hampshire with Northern Pass. But I think those challenges are a lot to do with permits and approvals, somewhat to do with the relative cost. But what I think about the Northeast US is this. I agree that there's lots of fuel security problems with natural gas. When you think about New England, they're on the end of all the pipelines. I think it's going to be very difficult to build new pipelines into New England. I think it's therefore going to be challenging to build a lot of new gas in New England. And I think that's one of the reasons why the states are looking at offshore wind. And I can think of one offshore wind project that's been contracted, and it's going to connect directly into New England's biggest load center of Boston. And knowing that price and knowing the price of the main project for Quebec, they're really similar. So my point is, if there are resources like offshore wind that are starting to emerge in the Northeast US, and New York is about to go on that sort of procurement for offshore wind, it's going to put cost pressure on the economics of injecting or exporting into New England. So it's just getting more competitive because of the emerging resources that we see in the Northeast with the technological advances and the cost decreases. But I think looking domestically, Quebec still has winter supply needs. And I think how that's met will somewhat depend on whether the New England Clean Energy Connect is actually built. And I think if that's built, then there's so many terawatt hours that are going to be injected into New England, and therefore I think there's a real strong need for more capacity in Quebec during the winter seasons. For whatever reason, if that's not built, there's still a need, but there's less, because you would think that with La Romaine coming on in its final units, there will be additional capacity and supply for Quebec. And I'll finish with this note, because I've had reason again to look at this. So when I think about the independent power producers in Quebec, whether it be the hydro or wind, some of those contracts are starting to come off, and the end of those power purchase agreements are happening, and there's been a renegotiation process with Hydro-Quebec. So I know for our firm, we're getting more and more calls, both from wind and hydro. What are our options if we don't re-sign with Hydro-Quebec? And what might we do? So I think that's something to look for, in the sense of the dynamics of Quebec's needs, but also the dynamics of the interconnected markets, and what's the art of the possible and what's the value of this. So with that, I'll leave it there, Nicola.